So how does a company grow its commercial revenue by, like, an astonishing 183% in a single year, secure this major infrastructure partnership with a legacy tech giant, and yet...
Have its own insiders dumping nearly 1 million shares.
Exactly. All while its cash runway is just physically evaporating before our eyes. Welcome to today's Deep Dive for Market Pulse Daily. We are getting right into the absolute high-wire act that is Rigetti Computing today.
Yeah, the tension defining this company right now is just palpable.
It really is. And real quick before we jump into the newest price action, a quick housekeeping note. You can check the description for a 14-day trial link to StockOracle, which helps make this deep dive possible. Just a heads up, affiliate links are used and, the AI insights or value estimates we discussed might be wrong. Plus, data could be delayed. We're looking at filings from August 24th, 2026, so keep in mind this is not financial advice and there are no buyer-sell ratings here.
Right. We're just here to break down the actual mechanics of what's happening.
Exactly. So let's look at the main catalyst that just hit. On August 21st, Rigetti's stock popped 11.48% in a single session, closing at $17.91.
Which is a massive move for a single day.
Huge. And for you listening, even if you never trade a single stock, this is like a masterclass in deep tech economics. It's this real-time case study of what happens when the bleeding-edge physics of quantum computing collides head-on with cold, hard capitalist reality.
Yeah, physics versus the balance sheet. It's a brutal fight.
Okay, let's unpack this. To really understand Rigetti's current strategy, you kind of have to forget those cliche analogies about, jumping out of an airplane and building a parachute on the way down.
Yeah, we've definitely heard that one enough in the tech space.
Right. Think of it more like they are building a modular space station in orbit. You can't just launch the entire massive structure at once because it's too heavy and way too expensive.
Right, so you design modular pieces or, chiplets in Rigetti's case.
Yeah, exactly. These pieces that literally snap together in a vacuum. And the engineering is brilliant, but maintaining the life support systems for the astronauts building it costs millions of dollars a day. And right now, Rigetti's fuel gauge is blinking red.
They are desperately waiting for a government resupply tanker to dock.
Yes. And if that tanker misses its window,
the entire station burns up in the atmosphere. The physics of building that space station are genuinely remarkable, but, the daily operating cost is brutal.
It's staggering.
And the market is constantly weighing those two realities against each other. They're trying to figure out if the commercial viability will actually arrive before the capital just runs completely dry.
Right. So let's examine that commercial viability first, because those concrete numbers are exactly what drove that 11% spike. So Rigetti reported Q2 2026 revenue of $5.14 million.
Which, like you mentioned, is that massive 183% jump year over year.
Yeah, and it met analyst expectations. But the narrative shift here is what's critical. They are actively transitioning from a grant-funded research lab where, scientists just run experiments.
Essential commercial hardware and services vendor.
Exactly. They are actually selling on-premises quantum systems now.
Yeah.
We also got fresh technical progress on their 108-qubit system, the Cepheus 108Q.
Right, the Cepheus system is a huge technical catalyst.
But maybe the most validating signal in this whole catalyst stack is their National Science Foundation-funded Tangle Lab partnership. That's with Hewlett-Packard Enterprise and the Pittsburgh Supercomputing Center.
Oh, yeah, targeting a 2027 deployment.
Right.
What's fascinating here is the mechanics of that transition. To really appreciate why the HPE partnership is such a massive deal, we have to look at the architecture of that Cepheus system.
Because building quantum computers is notoriously difficult, right?
It's a nightmare. Historically, scaling them has been nearly impossible because quantum bits or qubits are incredibly fragile.
Right.
If you try to build one giant monolithic chip with 100 qubits on it, the manufacturing error rate is just so high that your yield drops to near zero. You basically end up with a lot of really expensive, useless silicon.
So how does Rigetti get around that?
Well, their approach is a superconducting chiplet architecture. They manufacture smaller, highly reliable chips, say like 9-qubit or 32-qubit modules.
Ah, so those are the space station modules you mentioned.
Exactly. They manufacture those and then use a proprietary interconnect technology to weave them all together. They snap the modules together. So by partnering with HPE and the Pittsburgh Supercomputing Center, Rigetti isn't just proving their physics work in some isolated lab.
They're taking it into the real world.
Yes. They are proving that this modular quantum architecture can physically slot into a classical enterprise-grade server rack.
So it's all about interoperability. They're showing that a classical supercomputer can seamlessly hand off an incredibly complex calculation like, say, simulating molecular binding for drug discovery.
Yeah, hand it off to the Rigetti quantum unit, let the quantum unit solve the impossibly hard part, and then just get the answer back.
That makes sense.
Precisely. It is ecosystem validation.
Yeah.
I mean, legacy tech giants like HPE, they do not commit resources to a 2027 deployment unless they truly believe the underlying hardware can survive outside a controlled, sterile lab environment.
Right, the real-world durability.
Exactly. That interoperability is the entire foundation for Rigetti's long-term survival as a commercial vendor.
I mean, I definitely understand the technical milestone there, but I have to push back pretty heavily on the financial excitement surrounding this 183% revenue jump.
Oh, absolutely. Let's hear it.
Because, yes, triple-digit growth looks fantastic in a headline, but we are talking about going to just $5.14 million in a quarter.
Right. It's a very small base.
In the context of hardware manufacturing, especially manufacturing systems that require cryogenic cooling to near absolute zero, $5 million is essentially a rounding error. It's a tiny absolute number. The cost to research, fabricate, and maintain these modular chiplets vastly outpaces that revenue.
Oh, the absolute dollar amount is certainly not keeping the lights on. Not even close. But the market isn't rewarding the $5 million for its purchasing power. It is rewarding the proof of concept.
The fact that someone actually bought it.
Exactly. The transition from purely experimental research to a deployed commercial product is widely considered the most dangerous chasm in deep tech.
The proverbial valley of death.
Yes. The fact that a customer paid for an on-premises system proves that a recurring commercial revenue stream is theoretically viable. However, the reality of manufacturing physical superconducting hardware means that scaling production requires massive upfront capital.
Way before the economies of scale ever kick in.
Long before.
And the staggering cost of that physical manufacturing is exactly what creates this existential tension we see on their balance sheet. Because a $5 million revenue stream barely even makes a dent in their R&D expenses.
No, it doesn't.
Which necessitates a colossal, immediate infusion of capital. And based on our sources, that capital injection isn't coming from Wall Street. It is potentially coming from the U.S. government.
Right. The macro tailwinds here are huge.
Exactly. Just to provide some macro context, both the U.S. government and defense sectors are currently prioritizing quantum computing as a strategic national imperative. Now, we are simply reporting on the policy shifts here, but it is an objective reality that federal funding is opening up to secure domestic quantum supply chains.
Yeah, they want this technology built at home.
Right. And the specific major catalyst driving Rigetti's stock right now is a reported $100 million U.S. government grant under the CHIPS Act.
Which is a massive lifeline.
It is. But here's where it gets really interesting. Reading the transcript of their August 14th earnings call, that $100 million is not money in the bank.
No, not at all.
It is entirely conditional. The CEO discussed it as a letter of intent, an LOI, not a binding award.
If we connect this to the bigger picture, the strategic implications of that LOI structure are immense.
Yeah.
We really have to look at why a company with an extreme valuation relies on government grants rather than, traditional venture capital or public equity markets.
Right. Why not just go to Silicon Valley?
Because when you are building deep tech hardware, the timeline to profitability is often a decade or more. Traditional private equity rarely has the patience for a 10-year commercialization runway.
They want returns in 3 to 5 years, tops.
Exactly. But the U.S. government is stepping in to act as this cornerstone venture capitalist because they view quantum supremacy as a national security issue, not just a profit center.
And crucially, that government capital is non-dilutive. Let's frame why that matters so much to the shareholders driving this stock up right now.
Yeah, this is key.
If Rigetti were to go to the open market today to raise $100 million to fund the Cepheus system, they would have to issue millions of new shares.
Which dilutes the ownership stake of every single current investor.
Exactly. But a non-dilutive CHIPS grant provides the rocket fuel to scale their Tango Lab architecture without issuing a single new share. It fundamentally alters their capital structure.
The problem with an LOI, however, is the bureaucratic marathon required to convert it into actual cash.
Right, the red tape.
It's endless. A letter of intent means the government has selected them for the award, but it initiates this grueling period of due diligence. The Department of Commerce has to audit Rigetti's entire supply chain to ensure there are no compromised foreign components.
Wow. Oh,
Yeah.
wow.
They have to audit their intellectual property, their hiring practices, and their long-term financial viability.
Which takes time.
That process can take months, and during those months, Rigetti has to continue paying its engineers and funding its fabrication facilities.
Which forces us to look directly at the bear case, because their bank account absolutely does not have months of padding.
No, it's getting scary.
The cash drain detailed in their June 30th filings is severely alarming. Their cash and equivalents fell from $48.1 million in March 2026 down to just $27.6 million.
So in a single 3-month period, they burned through roughly $20 million.
Right. And the burn rate is actually accelerating because of the very technical milestones we just praised.
Yeah, scaling up to the 108-qubit Cepheus system requires incredibly expensive physical materials and specialized labor. Consequently, their Q2 operating loss widened to $28.1 million.
So they are trapped in a ticking clock scenario.
Absolutely. If you look at the first half of 2026 in total, they experienced an operating cash outflow of nearly $32 million.
It's like I said earlier, they have $27.7 million left in the bank, and they are burning about $28 million a quarter on operations. They are effectively running on fumes, hoping the bureaucratic red tape of the SHIP-ES Act clears before they literally default.
It's a total race against time.
And compounding this anxiety is their astronomical valuation. Rigetti currently trades at a price-to-sales ratio of 620.48, with a trailing net margin of negative 2,253%.
This raises an important question. Is the broader market completely ignoring the present-day financial risk because they are just mesmerized by the quantum narrative?
I mean, a price-to-sales ratio of 620 is a staggering metric.
It's almost unheard of. It means that if you bought the entire company today and Rigetti continued generating its current revenue, it would take over 6 centuries of that revenue just to match your purchase price.
6 centuries.
Yeah. And that's assuming they had 0 expenses.
Yeah.
For context, a hyper-growth, wildly successful software company might trade at 15 or 20 times sales.
Right, 20 is considered high.
So a multiple of 620 implies that investors are pricing in absolute flawless execution over the next decade.
But the thing is, investors might be pricing in perfection, but the people actually inside the company seem to be preparing for a much bumpier ride.
Ah, the insider selling.
Yeah. The data highlights a pattern of aggressive insider selling. We're looking at 10 recent open market transactions where insiders dumped a total of 966,900 shares.
Almost 1 million shares.
Almost 1 million shares sold by executives and directors, paired with absolutely 0 insider purchases.
Now, we have to acknowledge that insider selling is not always a definitive signal of impending doom. I mean, executives receive compensation in stock.
Sure, yeah.
They sell to cover tax liabilities, to buy houses, or simply just to diversify their personal portfolios.
I agree with that in isolation, but the volume here is what really stands out to me. 10 transactions, nearly 1 million shares, and an insider sentiment score of negative 84.03.
Yeah, that's undeniably heavy selling.
When the executives who are managing that terrifying $28 million quarterly burn rate are aggressively taking chips off the table, it strongly implies they understand exactly how precarious the LOI timeline is.
They know the math.
They know that if the government delays that $100 million grant by even 1 fiscal quarter, Rigetti will be forced into a massive equity raise.
And an equity raise at a 620x valuation, executed from a position of severe financial distress, would be catastrophic for the current stock price.
The market would punish them.
Severely. Institutional investors would demand a massive discount to buy those new shares, heavily diluting anyone holding the stock today. The insiders are likely just hedging their personal exposure against that exact scenario.
So, synthesizing all of this, the groundbreaking chiplet architecture and government backing on one side, clashing against a brutal cash burn and extreme valuation on the other. So what does this all mean? Let's trace the 2 diverging paths for this stock over the coming years, starting with the blue sky scenario. What happens if they thread the needle?
Well, just to be clear, This is an optimistic scenario, not a prediction. But if they thread the needle, the next 2 to 5 years look transformative.
Okay, paint the picture.
The $100 million LOI clears due diligence and converts to a binding award in the next few weeks, providing the non-dilutive runway they desperately need. The Cepheus 1108Q hits all its performance benchmarks regarding error rates and uptime.
And the HPE partnership.
By 2027, the Tangle Lab deploys flawlessly alongside HPE. Under these conditions, Rigetti transitions from a speculative startup into a federally anchored pillar of the U.S. quantum infrastructure.
That's the dream.
Yeah, their revenue compounds rapidly from that $5 million base as commercial enterprises begin licensing the tech. And that insane 620x valuation naturally compresses to a normal level simply because the revenue denominator grows so fast.
They successfully finish building the space station, the government tanker refuels them, and they establish permanent orbit.
Exactly.
But we have to look at the thesis breaker. What is the explicit risk that unravels this entire stock?
The thesis breaks the moment there is a delay. If the Department of Commerce extends the due diligence on the STEACH-APS grant, or if the final award is materially smaller than $100 million, the math simply fails.
Because they run out of cash.
Right, they run out of cash. They are forced to the public markets to raise equity. And because the stock has a beta of 2.05, meaning it is more than twice as volatile as the broader market, any sign of financial weakness will trigger a severe sell-off.
Because the market has provided zero margin for error here.
Precisely. When you are priced for perfection, you cannot afford a single technical misstep on the 108-qubit system or a single delay in the HPE partnership. If the narrative of flawless execution breaks, there are no fundamental earnings or dividends to provide a floor for the stock price.
It is the ultimate test of nerve for anyone analyzing deep tech. So for you listening, to wrap this up, there are 3 key things to watch next. First is the next major event. We are waiting for confirmation that the TTPS grant has converted from an LOI to binding cash.
That's the survival milestone.
Right. Second is the confirmation signal for the business. Watch for any technical deployment milestones regarding the HPE Tangle Lab integration. And finally, the main risk signal. Watch their quarterly cash burn. If cash drops below $28 million without that federal funding secured, the dilution risk becomes imminent.
It is a phenomenal example of how the most advanced physics on the planet are still ultimately tethered to the mundane realities of quarterly cash flow and government bureaucracy.
But I want to leave you with a final provocative thought to consider today. Something that isn't explicitly charted in their SEC filings or technical roadmaps.
Yeah, this should be good.
All the data we reviewed today focuses on the race for federal funding and the race to overcome the physics of qubit error rates. But what if the ultimate bottleneck isn't the physics? And what if it isn't the funding?
But what is it?
What if the real hurdle is actual real-world enterprise demand?
Oh, wow. Yeah, that is the variable no one can accurately model yet.
Exactly. Let's assume Rigetti executes perfectly. They build a flawless 108-qubit machine. The government fully subsidizes it, and the HPE integration is completely seamless. Are Fortune 500 companies actually ready to completely overhaul their legacy classical computing infrastructure to utilize it?
That's a massive ask.
It is. Moving from classical algorithms to quantum architecture requires entirely new software paradigms, new security protocols, and new specialized engineers.
Right. It's not just plug and play.
Getting the hardware to function in a server rack is a monumental feat of engineering, sure, but convincing a risk-averse enterprise market to abandon the systems they've used safely for decades, that is a completely different battle.
You can build a technological marvel, but if the broader market isn't prepared to rewrite its software to use it, you just don't have a sustainable business model. That adoption friction is the invisible risk hovering over the entire quantum sector.
So keep questioning the assumptions behind the headlines, everyone. Thanks for joining us for this deep dive on Market Pulse Daily. Don't forget to check the description for that 14-day trial link to StockOracle. We'll leave you to watch the filings, and let's see if that government tanker arrives in time.